My name is Garth Mackenzie, and I'm a technical analyst and an ETF strategist with Traders Corner. On the show this week, we're going to take a look at the VIX and the S&P 500 and where we are in this market cycle at the moment. It's been a really tumultuous time in the markets lately, as you'll know. The VIX has spiked up to above 80 this week, and the only other time that that's happened is in 2008 in the financial crisis. So I think this week we're going to take a look back at what happened in 2008 and compare it to where we are now and see what we can possibly expect from the market in the weeks and in the months ahead following this massive volatility spike. So let's take a look at my first chart this week, which is it's the VIX index, taking a look at the VIX in 2008 and again now in 2020. And you can see the similarities between the two charts over there. What's notable now is that the VIX spiked up very, very quickly this time. It went from a level of 15 and it got up to 80 in about 3 weeks. Back in 2008, it took a lot longer. It took about 2 months to get from the low levels all the way to the peak. So it just shows the speed of the sell-off that we've seen recently on the market. And it's been the fastest sell-off on the S&P 500 since 1987. So we're setting all kinds of records here at the moment. The next chart that I've got now takes a look at the S&P 500 in 2008 and again overlays it with the VIX at that time. And what's instructive to look at here is to see when the VIX spiked, but then also what happened to the S&P 500 after that. And what's notable is that the VIX spiked in October of 2008 this time, but the market didn't bottom then. It actually continued to move lower in the months that followed, and the market eventually only bottomed in March of 2009. So what I'm saying here is that there's a possibility that this recent spike that we've seen in the VIX doesn't necessarily mark a proper low in the market. I mean, it might mark a short-term low, and we may see a bounce off the current levels. But from a bigger picture perspective, one could potentially see further weakness in the market in the months ahead. The next slide also talks to this point quite clearly, and what it shows you is the bear market rallies that we saw in 2008, because there's two things I want to stress here. First of all, bear markets don't last just 3 weeks like we've seen. They typically last between 18 months and 36 months. And the second point that I want to make is that in bear markets, you'll see some of the most aggressive rallies that you'll ever see in your life. And in this chart, we can see that quite clearly. In 2008, notice how there were some major bounces that were very quick and very aggressive. We saw a 23% bounce, followed by an 18% bounce, and then a 26% bounce in the market. But notice that on each of those occasions, the market did make a lower high and ultimately also made a lower low. So if we believe that we're in a new bear market now, which I believe we are, then I think one needs to start honing your shorting skills, looking out into the next couple of months, and use these big bounces and big spikes up to potentially look to get short in the market. The next slide then looks at the VIX currently and the S&P 500 currently, and you can see how rapidly the market has fallen here. Basically, the S&P 500 has given up 30% in just about 19 trading days. It's been a very, very violent sell-off, and you can see how the VIX has spiked up, as I spoke about there. Now, if we contrast that back to the slides previously, you'll recall that, we could see a bear market bounce in this S&P 500 at some point, but I'm not sure necessarily that the low is in from a longer-term perspective on this market. The final slide that I've got here today shows the cycles of a bull market and a bear market, and this is quite interesting. And we've actually been through the phases quite clearly at the top of the bull market recently. You see how you get to the phases of euphoria, and that was recently where we saw things like Tesla going from $300 to $950. And there were a variety of other examples like that. But it now seems the market has cracked, and we've started to move down that curve, and we're probably somewhere between denial and fear in terms of the market cycle at the moment. The real opportunities come at the bottom of that, where you get discouragement and what have you. We're not there yet. So I think we've got to keep this in mind from a bigger picture perspective in terms of where we are in this overall bear market now. It's only just begun. That's all that I've got time for now. We'll be back again later this week with another show, looking at some more and possibly some ETFs.